Very good evening to all of you. Welcome to another YouTube live session with me, Srujit Kakkar. Today is Wednesday, 5th of Feb 2020. And before we move forward, let's get done with the formalities. So make sure you pause the video and go through the disclosure, which talks about the representations, the risk disclosure. I also have the next page, which talks about the risk involved in trading and also about the copyrights. So yes, today's session is a session which is going to be on the holy grail, which everyone is looking for. That is how to be profitable when it comes to trading. So today we'll be talking about what is the, I would say, one of the most important aspect when it comes to being profitable in trading, and that involves your risk management and your reward to risk ratios. So the first thing we'll be starting with it, that is it possible to be profitable on each and every trade, right? So now this is a question which I guess I get very frequently, and I always tell people that trust me that there is no such strategy in the world where you can be profitable on each and every trade. So you have to take it, or you have to accept it, that you will be having stopped out trades. There is no way to avoid stopped out trades. You will have winners, but yes, you will also have your losers. So first thing, I'll prove to you that there is no such strategy where you can be profitable on each and every trade. So what I'll do is I'll start with an example, and I'll start with an example of Goldman Sachs. Now Goldman Sachs, what they do is every year they print out a report, or they post a report which is called as the 10K report. Now this 10K report basically has a lot of different things which they include in that, but they also have one page on that report which talks about how their previous year has been as far as trading is concerned. So what I'm doing is I'm sharing some screenshots from those reports. If you want to find these reports, you can just Google for it, Goldman Sachs 10K, and you will be able to find these reports for almost every year. It's available as a PDF document on their official website, so you'll be able to find it from their website. Now if you look at this report, now I'm starting from 2012, so it's not that I'll be showing you data for one single year. I'll be starting from 2012 till 2018 because the report for 19 is not yet available. So I'm showing you from 2012 to 2018. So what you can see here is that we have a graph, and on this graph we have numbers 0 to 25, 25 to 50, 50 to 75, 75 to 100, and over 100. Now what are these numbers? These numbers are in $1 million. Right, so this means 0 to 25 million dollars, 0 to 25 billion dollars, 25 to 50 million dollars, 50 to 75 million dollars, 75 to 100 million dollars. Similarly, on this side you can see we have numbers in brackets. Right, now the numbers in brackets, they basically mean the negative numbers. Right, so this is minus 0 to 25 million, minus 25 to 50 million, minus 50 to 75 million, minus 75 to 100 million, and over 100 million. So now what are these numbers? These are their daily trading net revenue, right? So that means out of all the trades, all the days they were trading in 2012, how many days they made particular amount in that range or in that range. So example, you can see here that in 2012, they had 27 days when on average they were making between 0 and $25 million. They have 56 days when they were making between 25 and $50 million. They had 75 days when they were making between 50 and $75 million, and they had 37 days when they were making between 75 and $100 million, and similarly 41 days when they made over $100 million. But along with that, they also had 12 days when they lost between 0 and $25 million. They had 2 days when they lost between 25 and $50 million, and they also had 2 days when they lost between 50 and $75 million. Now, why am I showing you this? The reason I'm showing you this is because just by looking at these numbers, you can imagine that if there was any such strategy available in the world, which is going to make you profitable on each and every trade, these guys, they have that kind of deep pockets that they can buy that strategy for any price you would be asking for, right? So that is what I'm trying to prove to you, that there is no such strategy, because if there was some strategy where you could be profitable on each and every trade, then they will never be having these losing days. They will always be having winning days. And even if you talk about these days when they were making money, it's not that each and every trade would have been a profitable trade. Some trades would have been in profit, some trades would have been loss, but yes, net they were profitable. But now these are the days where yes, even if some trades were in profit, the trades which were in loss were not helping them to be net in profit. So if you look at your, again, 2012, right, they had these are the winning days, these are the losing days. So they had 16 days which were net in losses. And even if you talk about the winners, like I said, those winners will also be a mix of winners and losing trades. though net they were profitable. Now if you look at the next year, which is 2013, right? So again you can see they had 27 days when they were net losing money in the market, right? So yes, they had their winners, but they also had their losing days. Again, like I said, the winning days would also be a mix of winners and losers. Look at 2014, 28 days when they lost money, and rest of the days, yes, they were making money, but again the winners will be a mix of winners and losers. 2015, 42 days when they lost money, and rest of the days they were making money. 2016, 30 days when they lost money, rest of the days, yes, they were making money. 2017, 31 days when they lost money net in losses, rest of the days, yes, they were making money. And 2018, you can see 31 days when they lost money, and rest of the days, yes, they were making money. So one thing which I have proven to you is that you can see even these big boys, it's not that they are making money on each and every trade. They have their winners, they have their losers, but what is keeping them profitable? And this is something you can see consistent from the data which I'm sharing with you. Let's start from 2012. You can see what is keeping them profitable. So the thing which is keeping them profitable is, you can see whenever they have losses, their losses are always very small in number and also small in values compared to the winners. So the winners are always big, the losers are always small. If you look at the next year, okay, let me delete this. Let's go to 2013. So if you look at the next year again, can you see the maximum number of losses, which is 23, was just between 0 to $25 million. But if you talk about those big losses, just two. So can you see their losses are always small, their winners are always big. Look at the next year, 19. Yes, they had 5, they had 4, but again, majority of the losses are always small losses, very few numbers of big losses. Look at the next year, which is 2015. Again, you can see majority of the losses, small losses. Look at the next year, 2016. Can you see 0 to 25, then 25 to 50, not even one single loss which was between and $75 million. Look at the next year, 2017. Again, we are maximum having a loss which was between 25 and $50 million. But if you look at the winner side, you even have winners which are more than $100 million, right? 4 such days when they made more than $100 million. Look at 2018. Can you see just 23, 6, 1 and 1? So what you can see here is that the key to profitable trading was good risk management. So whenever they were taking trades, their winners are always big, their losers are always small, and this allows them to be wrong maybe more number of times and still be a profitable trader. So that is why risk management and reward to risk ratio is a very, very important aspect of your trade plan, because the proof, the fact is that there is no such strategy where you will be making money on each and every trade. You will be having winners, you will be having losers. The only way to be profitable is by ensuring that you have small losses and big winners. Now the question comes, what is your reward to risk ratio and how do we identify that? So because I teach demand and supply methodology, I'm just giving you an example. And the best part with demand and supply methodology is that you can calculate your reward to risk ratio even before you enter the trade, right? So even before you place your order, you will know what is your reward to risk ratio. If that reward to risk ratio matches with your trade plan, only then you place your orders, otherwise you don't place your orders. So let's take an example that we have identified a supply zone on the chart, and now we have also identified a demand zone on the chart. So what happens now is, because I know where my supply is, I know where my demand is, I will be knowing my entry price, because wherever the supply is, let's say I want to plan a short trade. So this is my entry price. So let's assume that entry price is 100 rupees. Similarly, I also understand if the prices they go beyond this zone, I should be taking that loss and exiting with that small little loss. So what is my stop loss? My stop loss, let's assume in this case, is 101. And since I know this is where demand is, so what can happen is, once the prices they hit this supply, if it goes above, yes, we have our stop loss to protect us. But in case prices they start moving down, we know that from this demand it can also move up. So this demand area will be my target. And let's assume that target is 97. So what I know even before I entered the trade or even before I placed my order, can you see as of now the order is not placed, but I still understand what is my entry, which is 100 rupee, what is my stop loss, which is 101, what is my target, which is 97. So what risk am I taking on this trade? I'm taking a risk of 1 rupee. And what is my reward on this trade? My reward is 3 rupees. So can you see, even before I entered the trade, I understand my risk is 1, my reward is 3 times. So should I be taking this trade? Absolutely yes. Why? Because now I am taking a trade where my reward is much bigger versus my risk. And what is the advantage of that? We will be talking about as we move forward. I'll show you graphically what is the advantage of that. But yes, before we move forward, let me add that the sessions which I'm doing, I do about 3 live sessions per week. The Sunday session, the timings are fixed. I do it 10 a.m. to 11 a.m. But the other 2 sessions, the timings and the days are not fixed. Generally it is on Wednesday and Friday, but the timings are not fixed. So how can you get notified for it? For that, make sure you subscribe to my channel, hit the bell icon and select all notifications. What I do is 10 to 15 minutes before the session starts, I start a countdown timer. So if you have subscribed to my channel and if you have hit the bell icon, you will get a notification 10 to 15 minutes before the session starts, and then you'll get to know that the session is about to start. And if you wish to join live, you can definitely join in live. And I would also like to add that these topics which I'm taking are the topics which you people are asking me. So if you want me to take any topic, make sure you put it in the comment section. And yes, if you're liking these videos, hit the thumbs up button, share it with your friends. If you're on some trading groups, share it on those groups so that other people can also take advantage of it. So just give me 1 second, right? So just 1 second. All right, so let's get back. Perfect. So this is what is telling me my reward to risk ratio. So now what I'll be doing is, because I can see that yes, I have a good reward to risk ratio, I can place my order. So let's assume prices. So what is my reward to risk ratio? Like I said, we are having a reward of 3 for a risk of 1 rupee. So once the prices they come into the zone, we can take that trade. If it goes above, yes, we have a stop loss to protect us. In case it goes down, we know where the target can be. Now, this is what I'm showing you as a PPT, right? Now, let me show you the same thing as a real life example. And this example is from the Sunday session where we plan some areas of demand and supply. So let me bring up the chart for Nifty. Now, if you look at this, in fact, if you watch my Sunday session, the recordings are already available. So you will see that when we did the session some time back, this is what we marked as our area of demand. And on Saturday, the budget day, what happened? Market, they crashed like anything. And can you see, when the markets, they crashed, they came into my demand area. So when the prices are coming into my demand area, I can clearly see on the chart that now we have a supply area, which is maybe somewhere around here, which is more like a drop-based drop. So that is where I can see my target, right? So that's my demand and that's my supply. So what is the chart telling me? Can you see, even before you entered the trade, the chart is telling you that if you are taking this trade, this is going to be your risk. And if you're looking for your reward, this is what your reward can be. So you basically have a reward to risk ratio, which is maybe 3:1 or 4:1. So should I be taking a trade with a 3:1, 4:1? Absolutely yes. What happened? Prices came to that demand. Can you see that demand was not violated, started moving up, and probably today you would have got your target, right? And you're done with the trade. Now, this is something which was planned well in advance. You can go through my Sunday recorded sessions. You can see that all these zones which I'm planning are always well in advance. I will also show you the similar example on Bank Nifty. We also identified, where is the zone for Bank Nifty? This is strange. Why am I not able to see it? Probably it's just taking some time to load. Perfect. So there you have it. So can you see, for Bank Nifty, we mark this as our demand area. We also mark this as our supply zone. So on Saturday, right, because of the budget, prices, they just crashed like anything, came into that demand. Can you see, just touched that demand, and probably, in fact, yesterday you could have got your target. And if you look at your reward to risk ratio, probably you have more than 2:1, maybe a 3:1. So this is why the demand and supply methodology is such a methodology where you can pre-plan your trades. Even before you enter the trade, you will get to know what your reward to risk ratios are. Like here I can see, in fact, if I just want to quickly see what is my reward to risk ratio, let me draw this tool which I have modified to help me understand what are the reward to risk ratios. So you can see this is 1:1, 2:1. We had almost 3:1 reward to risk ratio on that trade. And you can see that's your entry price, that's your stop loss price, that's your target. In about 2 days, you got your target. And this is the beauty of the demand and supply methodology. Things can be pre-planned. Before entering the trade, you know where your entries are, you know where your stop losses are, you also know where your targets are. So now let's move on to the next step, which is why reward to risk ratio is very, very important, right? So let's look into that. So now what I've done is I have created this Excel sheet. Now this Excel sheet is basically an Excel sheet which graphically will show you the advantage of having good reward to risk ratios. So let's imagine that we start with a capital of 1 lakh rupee, right? So that is what I have here. That let's imagine your capital is 1 lakh and you are planning trade with 1% risk per trade, right? So 1% risk per trade would be 1,000 rupees because 1% of 1 lakh would be 1,000 rupees. And let's assume that you're always taking trade only if your reward to risk ratio is 2:1. If your reward to risk ratio is anything less than 2:1, you are not taking that trade. And let's assume that your hit rate is 50%. That is why I've given hit rate as 0.5, which means now this is a sample size of 50 trades. You can see I have created a sample size of 50 trades. So if we have a sample size of 50 trades with a hit rate of 50%, that basically means that I will have 25 winning trades and I'll have 25 losing trades. Now what I'll do is whenever I'll refresh this sheet, it will create random results, right? It will have 25 winners and 25 losers, but these 25 winners and 25 losers will be calculated randomly. Like here you can see the first trade was a winner, second is winner, third is winner, fourth is win, fifth is win, sixth is win, seventh is win, and then we have 2 losing trades. So I'll refresh it so that initially we have a losing streak. So can you see now my first trade was a losing trade, the second trade was a losing trade, third one was a winner, then we had again a losing streak of 3 trades. But as long as your reward to risk ratios are good, so can you see you started with some negative hit on your account, but because your reward to risk ratios were good, over a period of time you ended up being net profitable, and that too just by being right 50% of the times. So what is keeping you profitable here is not the hit rate, right? Because generally people, they ask me, what is the hit rate? Do you have 80% hit rate, 90% hit rate? So I tell them, it's not required to have an 80% hit rate or a 90% hit rate. If your reward to risk ratios are good, you can be a profitable trader even if your, let's say, hit rate is just 40%. Now can you see with 40%, we started with 1 lakh and we ended up with around 1,10,000. Right? So did we have losing trades? Absolutely yes. Can you see we had 1, 2, 3, 4, 5, 6, 7 losing trades in a streak. And that is why I always tell you that you cannot judge any trading strategy on a very small sample size. You will always need to have a big enough sample size to understand whether things are working for you or whether things are not working for you. So here we are taking a sample size of 50 trades, and can you see with 20 winners and 30 losers, net you were still profitable. Now let's assume if you are only trading for a 3:1 reward to risk ratio, now you can be wrong even more number of times. Now your hit rate is just 30%, which means out of 10 trades, only 3 trades they go in your favor, 7 trades you're getting stopped out. So you can see 15 winners and 35 losers, but still you started with a 1 lakh rupee capital, ended up with 1,10,000. So the bigger the reward to risk ratio, the better it is for us, because now I can be wrong more number of times but I can still be profitable. But the smaller the reward to risk ratio, now I need to be right more number of times to be profitable. So what is the holy grail to being profitable trader? The holy grail is not your hit rate. The holy grail is your reward to risk ratio. The better the RRs you are trading for, the better your results would be, even if you have more number of stopped out trades. But yes, now coming to demand and supply methodology, once you have good enough experience and understanding of the process, maintaining between 60 and 70% is not a very big challenge. It can be done. But yes, again, it is not required to have 70%, 80% hit rate. Even with a 50% hit rate, like I just showed you as an example, even for a 2:1 reward to risk ratio, you would be doing really nice. Probably once you start getting close to 35%, that is where maybe you might start getting into losses. But you can see even with 35% hit rate, you are still in profits, right? So if we go a little below 34%, you're still in profits. If we go 33%, you're still in profits. If we go 32%, now you start getting into losses, right? So as long as you're maintaining, let's say 35% or above, with a 2:1 reward to risk ratio, you can net be a profitable trader. Yes, you can have a losing streak, but what is keeping you profitable again is not the hit rate. What keeps you profitable is your reward to risk ratio, and that is why reward to risk ratio is such an important aspect. And I also showed you with the example of Goldman Sachs that they are also doing exactly the same thing. Their losses are always small, their winners are always big, and that is the only way to be profitable in these markets. Because there is no such strategy which will give you profit on each and every trade. You will have winning trades, you will have losing trades. The only thing you need to do is minimize your losses and have bigger rewards, and that's the key to being a profitable trader. And this is why the risk management and reward to risk ratio is one of the most important aspect of any trade plan, and make sure you incorporate into your trade plan if you've still not done that. And this is what I wanted to take as today's topic. I will also be doing the same topic in Hindi very soon. And now, before we end the session, let's look into what do we have in the chat box. So just give me a second. If we have some questions, queries, I'll quickly answer them and then we'll end the session. So very good evening, sir. Is there any screener for finding stocks based on demand and supply zone trading? Absolutely yes, Ashish. There is only one scanner available in the world as of today, which is what I call as the alert service. So I have created my own scanner, which is purely based on demand and supply methodology. And what you can do is using that scanner, it will tell you on which stocks demand and supply zones are getting formed. You can try the demo version. The demo version is also available. You can go to surjitkakkar.com/alerts. I think the link is already provided in the description. Click on that. Video is provided which will explain you what the alert service is all about. You'll get the complete information. Plus, it will also provide you the link to the demo channel. We have a demo channel for the NSE, we have a demo channel for MCX, and also a demo channel for Forex. So you can join that demo channel. You can try it out for as long as you wish to. And if you feel that is going to help you, then you can go for the subscription where you will be getting the alerts throughout the market hours. So that answers your question, and that also brings us to the end of today's session. Thank you so much for joining in, and I will be seeing you very soon. Till then, trade safe, enjoy your evening, take care, bye bye.